What a close this week. Let's kick this off with some market updates and wrap this up with some key earnings.
Very choppy week this week. News release on Thursday showed that US Q4 GDP grew 6.9%, closing out a strong year for economic growth.
And it turns out that 2021 saw the highest yearly growth in GDP since 1984.
This number is telling us that Omicron variant has had far less of an impact on the economy than what we thought it would have. And this data likely supports the Fed decision to aggressively raise rates and speed up tapering.
Yep, Fed tightening is likely to continue to weigh on the valuations, pretty much on most tech stocks, unless, they can keep on reporting rising corporate earnings to offset this headwind.
Well, this has happened in the past. In each of the last 5 rate hike cycles since 1985, the S&P 500 generated moderate but positive return between the first rate hike and the last.
But that was supported by a strong growing economy. I can tell you what we have now is a really strong growing economy, not with a 7% inflation rate and coronavirus.
This suit is black.
You might have that right. So what is the takeaway from Powell's speech on Wednesday?
Well, he said McDonald's cheeseburger might be more expensive soon, and there's a risk that inflation will not decline back towards its pre-pandemic levels anytime soon.
Also, the Fed is poised to raise rates for the first time since 2018, and the balance sheet tapering is expected to start in March.
Meaning the Fed will no longer be providing stimulus or liquidity via balance sheet expansion. So what does it really mean to you?
Less money flowing into the market. So stock prices might not rally up as fast as in 2020 and 2021.
Right now, we're expecting 5 rate hikes for 2022, but Powell didn't specify a target number of hikes this year and said, there's quite a bit of room to raise interest rates without threatening the labor market. Whatever that means, right? But hello, is it really that hard to say 1 or 2 or 5?
Well, that's his job. Keep us guessing. But very likely we are expecting a 0.25% rate increase at every meeting in the early months of its tightening cycle.
And so what does this mean for markets and the economy?
The market is pricing in the expected number of rate hikes this year. A lot of companies are down more than 50% right now, and the volatility this past couple of weeks is just great for day traders.
Wow. Historically, 1 to 3 corrections in 5% to 15% range are the norm in any given year. And now the S&P 500 is officially undergoing a 10% correction from recent highs, and Nasdaq closed the week slightly below 15%.
This is expected, but just kind of feel sorry for Cathie Wood. All her ETFs are down more than 50% from the high.
Oh, on that note, did you hear about the anti-ARK ETF, SARK? The fund size is now at 334 million, betting against her.
That's unfortunate. Well, we have a nice Friday bounce, and the S&P 500 and Nasdaq both closed slightly positive for the week. Not surprised to see the Dow Jones up about 1.2%.
So what else are we watching besides the current inflation readings and every Fed moves?
Q4 earnings season is now underway. About 33% of S&P 500 companies have reported, and we will be going over some of the big names reported this week.
And stay tuned for Apple ER breakdown and a company that is very well known, but we haven't covered before. Also, we should keep our eyes on the tensions between Russia and Ukraine. We're going to expect some volatility in energy markets given that Russia is one of the world's largest oil producers.
Yep, energy sector and oil prices took off. So let's see how this turns out.
And as for next week, we think volatility will keep going, but likely sideways at a wider range. But we don't think it will be too concerning on the downside, as some of the big names are also reporting next week.
Let's go over some notable earnings this week, and we will talk about zones to buy.
We have a lot to talk about today. Let's get started with
Apple's Q1 FY 2020 earnings. As usual, check out the screen for report card.
Almost straight A's for Apple. Only iPad sales didn't beat estimate, and the company says that that's because the supply chain issues. But looking at all other products that beat on sales, you know Apple is prioritizing other products for shipping, which is why iPad sales missed.
On the forecast side, we can expect
Frames,
year-over-year
stainless steel
growth for the
bands.
next
Each
quarter,
band goes through a
but will be
physical
slower
vapor
than
deposition
this quarter
process
that
to
just
create an
reported.
Apple custom
Two main
band
reasons.
that is so
First, because 1 year ago, the same quarter got higher growth because iPhone 12 release got delayed. iPhone 12 event was mid-October and didn't start shipping until early November. So the bump in sales got recorded in the following quarter. But for this year, iPhone 13 release was in September, so the bump got recorded a quarter earlier. Then second reason is some foreign exchange losses, so expect next quarter growth to slow down on the number side.
That's reasonable. I mean, look at the gross margin. I look at my phone and damn, almost half of my phone is basically profits. Think about that.
Apple brings the luxurious value, so this is where you can say, okay, for some company, you can't just look at its earning. You need to consider the intangibles.
Yeah, unlike those companies that are PPT, those are your speculative quick flips. So trade them as such. Know your risks.
Got a bit sidetracked, so back to Apple. Where is the buy?
So based on Apple's valuation until September of 2022, it's between 110 to 147. And for next September in 2023, currently, the valuation is about 118 to 158 based on forecast. In other words, end of Friday, Apple hit 170. You should know if Apple is undervalued there. I've sold my leftover base Apple position today as well, around 167. Super small though.
Like I mentioned earlier, it brings some extra value with the brand. So my buy is between 140 to 150. Don't think it's gonna be trading under value or at the value.
I agree. I like 140 to 150. Moving on to some finance earnings.
Visa turned in their homer Thursday after hours and Friday popped over 10%. Check out the screen for the summary if you want.
Pretty strong year-over-year growth in payment volume of 20%. Cross-border, but not including Europe, hit 51%. Total cross-border volume hit 40%, and total processed transactions hit 21%.
Great report card. So where's the zone for us?
The fair value for end of 2022 should be between 190 to 250 based on the earnings forecast. So, I mean, if you want to do a mid to long-term play, we would look at between 200 to 210. But if you are more aggressive and short-term, I believe 190 to 200 is a solid support.
I agree. Overall, Visa is impacted due to the pandemic. So eventually it will recover. And plus, its fundamental is still the same and remains stable. It is not a big problem for long-term hold.
Since we just talked about Visa, I'm sure some of you guys play Mastercard as well. So let's quickly cover that. Check out the report card on set screen.
The report card is not as good as Visa. Don't get me wrong, it's good, just not as good. But Visa carried. So what a beautiful close on Friday, up almost 10%.
Mastercard's cross-border payments already recovered all the losses from pandemic and now more than pre-pandemic volume, so that's a very good signal.
The forecast is pretty average though. So for January payment data that they just disclosed is lower than past quarter monthly average. The growth of 27% is lower than Q4, 31% growth. And Mastercard didn't change its full year guidance at all.
I guess let's see if they will raise guidance next quarter. For Mastercard's fair value, at the end of 2022 should be around 300 to 430, so midpoint is at about 365.
My buy zone is between 300 to 310. Mastercard big direction is still positive.
I like that as well. Lastly, let's go over a place I go every week, McDonald's.
I believe we never covered McDonald's before. Let's look at the earning on screen, as we got a little McDouble not beat this quarter.
Slight miss on both EPS and revenue. Let's go straight to fair value. End of year 2022, McDonald's should be between 220 to 280. So midpoint around 250. So right around here. Friday closed at 256.
So everyone knows what McDonald's do. Everyone knows what the fuck they represent at 2 a.m. after bars. So likely it's not gonna dip too hard. I like around 235 for McDonald's.
Yeah, I will add some at 240 actually for midterm.
Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.